straight from school, I spent my working life in financial markets, commodities particularly, but dealing in many, many different global currencies. And my transition into politics all came about because one evening in October 1990, and we'd had a day, been working on the London Metal Exchange, and we were in the bar afterwards analysing how well or badly we'd done, and I heard the news that we joined the exchange rate mechanism. We'd pegged sterling against a basket of European currencies, well, effectively the Deutschmark, really. And everyone thought it was a great idea. The CBI approved it, the TUC approved it, the press approved it, all the political parties approved it. This was going to be marvellous, and I thought, well, I'm not so sure about this, it's going to be a disaster. And I began to understand that what was really happening was the British establishment was softening us up to join what ultimately, 10 years later, became known as the euro. And it was the understanding of where we were going, of what the so-called common market was evolving into, that motivated me to get into politics. Now, thank goodness, we did not join the euro, and I think we've got Jimmy Goldsmith and Rupert Murdoch very much to thank for that. We didn't join the euro, but of course the rest of the continent, or most of the rest of the continent, proceeded with it. I have thought from very early days that it was unlikely to work because it was effectively a political project, and I could never understand for the life of me how the north of Europe and the south of Europe could live together inside an economic and monetary union. Well, as you know, with the Fortune and Freedom project that I'm working on now, I'm working with South Bank, who've got some top researchers and writers, and one of them is a fellow called Nikolai Hubble, who's produced this book, How the Euro Dies. Nikolai, tell us a bit about your background in financial services.
Yeah, so it all started with a scholarship from Goldman Sachs.
Sorry, did I hear Goldman Sachs?
Unfortunately, you did.
Oh dear, sorry, viewer. Right,
as embarrassing as it may be.
But Goldman Sachs, of course, were the architects of the euro.
That's right, with Mario Draghi helping Greece in, and it didn't work out very well for Greece, and it hasn't worked out very well for anyone else. But luckily enough, it did work out well for me, really, because I saw what the financial services industry was really like behind the scenes at their worst during the financial crisis. So I was able to see that really they weren't able to help their clients. What they were able to do working at Goldman Sachs is help Goldman Sachs. And I realized that I'm not really able to go to work doing that every day. Pretending that I'm helping investors and clients, when really I'm furthering a company's mission to make money and meddle in politics as well, if you're honest about Goldman Sachs. So even though I'm very grateful for the scholarship, I avoided all of that, and I went to write newsletters instead. And the way I usually explain it is that instead of working for the bankers that cause financial crises, I work for newsletter companies that expose when they're going to happen and explain why they're going to happen and tell people how to protect themselves.
We're going to come to that, because it's very interesting, because to criticise the euro, to doubt whether it can continue to exist in its current form is akin to heresy. I remember in 2016, a public debate on Brexit. I was on one side, ex-President Valéry Giscard d'Estaing was on the other, and it was hosted by The Spectator. And there was a dinner afterwards at the Spectator office, very good dinner, and Andrew Neil was in the chair. And Neil asked the former president a question. He said, well, do you really think, Giscard, that Greece and Italy can stay part of the EU? And the response was extraordinary. It was sulphurous. It was utterly condemned. How dare the British even comment on it? And I know myself from the European Parliament that no criticism of this project is allowed. My contention that this was all about politics, and they thought that if you had an economic and monetary union, that political union would inevitably follow as night follows day. Some would argue, Nick, that with the agreement of quite large transfers of money, during this pandemic, the money's not yet been transferred, but some would argue that the euro is bringing political union in Europe closer.
Yeah, so the model that they follow for this is they put together countries into a policy, European policy, and that causes problems. But the euro and the EU are sort of a one-way process. There's only ever more integration. So each time you get a crisis, the solution is not to reverse the policy, it's more integration. And that's the genius of the thing. So especially in terms of monetary integration, so the launch of the euro and the ERM before that, it's designed to create a crisis. And even the chief economist of the ECB, when they first launched it, he made it very clear this is not going to work. But the politicians made it clear this is a political project. And the fact that it won't work, sure, it's going to lead to a problem. But what's the response going to be? It's going to be more fiscal integration. And that's what we've seen now with COVID. This discussion about Eurobonds, and there was a compromise that it wasn't quite Eurobonds, but basically you've got North and South Europe financing each other, helping each other in ways that the Germans especially were guaranteed would never happen. And they only were willing to sign up to the euro under that guarantee. So each time there's a crisis, whatever the cause, the euro is one of the many causes, there's more integration.
Yeah, and that's been the push all the way through. Now, I mean, many would argue that Germany's done rather well out of the euro, because had they had the Deutschmark, it would have been at a much higher level than it is being in the euro, because it gets kind of dragged down by the South and by other countries. Clearly for the South, it really has led to some very, very dire consequences. But there's one aspect of all of this, and one part of this story, and it's complicated and it's difficult to explain, but I want us to talk about it. It's called Target 2. I've spoken to some quite important German politicians who are virtually oblivious to what Target 2 is. And Target 2, well, for me, Target 2 means the north and south of Europe are kind of in a deathlock with each other. And Nick's going to explain why.
Yeah, so this is the toughest thing to explain with all of it. And even inside the euro system, the experts disagree. There was a huge debate about it, and it actually led to a court case in Germany where nobody quite understands what it is or what it does or what the consequences are. What is clear is that when you've got multiple countries in a monetary union, doesn't matter whether it's the euro or a different monetary union, you have this problem where they have a trade imbalance between each other. And so you've got money flowing, in this case, from Greece to Germany all the time.
So the Germans are selling military equipment, for example, which they do in large amounts to Greece.
Submarines, strangely enough, that's right, yeah. And so the money is flowing from Greece to Germany. But the money has to go back to Greece somehow, otherwise you get this imbalance in the amount of money. Right? You can't have basically a shortage of currency in Greece. You need to get the money to go back again. And Target 2 is the system that pushes the money back again. Now that's all fairly clear, and that was understood and known about Target 2. What the big drama is what's the consequence of that? Because if the Germans are sending cars or military equipment to Greece, and they're getting money in return, but they're sending the money back again, well then what are the Germans actually getting in exchange for the stuff that they're sending down to Greece? And what Target 2 is, according to some experts, is a debt. So Greece then owes Germany the value of the cars and the submarines that were sold. And that's what the chart of Target 2 shows, the Target 2 imbalances. So it's the debt that Greece owes to Germany because of these trade imbalances. The problem with that is that the trade doesn't rebalance. So normally when two countries trade, the tendency is for the trade imbalance to rebalance by having currency exchange rates move. That doesn't happen in the euro. The euro is the same between Greece and Germany, so the exchange rate can't move. Because of that, the Target 2 balances are getting more and more imbalanced. So Germany's owed more and more money by countries like Greece, and Greece owes more and more money to countries like Germany. And this growing imbalance over time basically creates the pressure and that you describe as the deathlock that will eventually cause a crisis in Europe.
Because none of that matters, all the while it's an accounting entry. But it does matter if someone defaults on it.
That's right. So the best way to highlight why it matters in the end is the Germans are looking at this huge debt that's being racked up by Greece, which is interest-free. Nobody acknowledges that it's a debt, and they're starting to get worried about it because the Greek economy is getting worse and worse and worse over time. So eventually, if the Greeks decide to leave, well, the Germans won't get anything back for all of those submarines and all those cars that they've been selling down south. Now, most of the economists at the ECB acknowledge that much. What they don't fully acknowledge yet is that it's not just about trade balances. It's also about capital flight, meaning this is where Italy comes into the picture. When Italians are panicking about their banking system going bust, what they do is they send their euros to the safe banking system of Germany. That shows up in Target 2 as well because it's a money flow. Right? So when Target 2 balances are really spiking to record levels, that's telling you that depositors are shifting their money out of the Italian banking system into Germany or wherever it's going. So it's also a signal of a banking panic that's breaking out. That's what happened in the European sovereign debt crisis of 2010 to 2012. That's why Target 2 was so important then, because it was like it's basically like watching capital flight in a mirror. So you can see this crisis unfolding, and Target 2 is telling you what's going on behind you.
And it measures it.
Yeah, and it's exactly
And it measures
precise
it.
metric.
Yeah. Well, as I say, I'm pleased you talked about it. I know, unless you're an economist, it's a difficult thing to get your head around, but there is a massive problem here.
Even the economists don't figure it out.
Well, I think that's
debating
probably
about
true.
it all the time.
Now, Greece. We talked about Greece. Now, I remember the election. I remember Tsipras getting elected. I remember Varoufakis walking up Downing Street in a leather donkey jacket. I thought, crikey, these boys are the real deal. And then Tsipras went to Brussels, met with the Commission, met with the European Council. And I was sitting in the front row when he walked into the European Parliament to give a speech. And I could see, looking at his eyes, there was a beaten man. Everything he'd promised the Greek people, clearly he wasn't going to fulfill it. What they threatened him with, I just don't know. But as I understand it, I mean, the Greek economy has fallen by 25 to 30% over the course. It was almost double the rate of the Depression back in the 30s. But it seems to me that the Greeks have just given up.
Yeah, well, they did. They effectively did. And it's a very similar model to what's happening now with the Brexit negotiations, where the Europeans basically just stall, knowing that the other side's in trouble. But the European Commission doesn't really have any political pressure on it from any electorate. So they can go to the wire. Whereas, Tsipras and Varoufakis were worried about the electorate. They're politically accountable to their people, and Boris Johnson's politically
Bread
accountable.
not being in the shops, and no money in cash tills,
That's right.
and all of that kind of thing. But see, the point is this, that you've outlined in this book how the euro dies, the flaws with the project from the very beginning, the massive problems that Target 2 and other measures are showing us exist within. The fact that the South and the North just cannot live together inside the same currency and same economic and monetary union. And I get all of that. But the point here is that if countries just give up, if political opposition to the project ceases, then the euro doesn't die. And as I say, I've watched Greek politics incredibly closely. And it seems to me the Greeks are just watching their country becoming a third world nation, and any spirit of opposition appears to have been beaten out of them. But the thesis in this book is that the Italians are different.
Yeah, that's right. They're big enough and they're a bit more politically dangerous, and they already have leaders who in positions of power who are willing to push the EU, I think, much further than the Greeks did. Basically, the way I would describe it is that they're playing Russian roulette, but they're loading more and more bullets into the gun over time, and basically saying to the EU, either you start allowing us to behave like Italians on the budget, or we leave and your big pet project blows up because of it. So they've got a lot more negotiating power to do that. Mm. The worry is what that means for British people who are worried about banking crises and saw what 2010, 2012 did to the UK stock market, to their pensions, and to UK banks. And so we know the risk is massive. So if the Italians, even if they're willing to push the matter quite far, that is enough to cause a crisis. And that's what we saw at the end of 2018, when the budget negotiations did lead to massive crashes in the stock market. I think it was the worst period since 2008 in terms of how much value the stock market lost. So this risk of Italian politics leading to another big standoff with the EU really can hurt people living in the UK who don't realise about any of this and think we've escaped because of Brexit.
So the political will in Italy you see as being different to that in Greece. They're a bigger country. They've had, I think, no growth for 20 years.
That's right. So one of the unique things about Italy is that other nations saw either a big boom and then a bust, or in the case of Germany, it actually suffered quite badly under the euro for the first few years and then had a big boom after the financial crisis. So some countries like Ireland have had this big, I guess a mess really of booming house prices and a big bust, and other countries have now benefiting from the euro while they suffered before that. But Italy just constantly suffered. They never had the big boom. They've just been struggling that whole time. So that has allowed a much stronger base of Euroscepticism in the country to build slowly over time.
And if the political pressure is there to have a complete loosening of the rules of the Eurozone, the Germans presumably can't really allow that to happen.
That's right. So basically the Germans are being asked to pay for the Italians breaking the rules.
Yeah.
And the reason the Germans won't be willing to do that is because the period I referred to a second ago, where Germany suffered under the euro for a long time, the Germans did stick by the rules then.
Yeah.
You know, so if the Germans say, well, we went through the austerity that we're now preaching the Italians need to go through, why can't they do it? And if the EU starts to side with the Italians, then the Germans will start to pull the plug. And interestingly enough, as I explain in the book, one of the ways the Germans can fight back is through the Target 2 system. So they can decide to cap how much they're willing to lend via Target 2. And I think that's one of the ways that all of this could blow up if the EU starts to side with the Italians instead of with the Germans.
When does it all? I mean, I know that's always the hardest question to ask anybody, and I've often flippantly, when I've been asked a similar question, said, "Well, if I knew the answer to that, I'd be down at Ladbrokes and not talking to you." Do you have any feel yourself for the time frame of this?
It's difficult because of the many different ways it could unfold. So, if, for example, the EU starts to side with Italy and the Germans are required to act, that'll take quite a long time. If we're waiting for Italian politics to change, then it's the Italian election cycle that matters most. So because there's, I think, 6 ways that I highlight how it could unfold, the timing is incredibly difficult. My expectation, I guess COVID as well, has shown that it's pretty difficult to figure these things out. My expectation is that next year, as COVID starts to settle and people start to realize what damage COVID has done, the whole Euro project will come into question by all nations. Because basically they don't want to be stuck with a euro that is valued for the German economy. They want an economic recovery, and one of the few ways that they can get an economic recovery is by leaving the euro and getting their own exchange rate back.
Well, it's a fascinating thesis. It's very, I have to tell you, very, very well argued. I don't just say that because I agree with it, but it is well argued. And if and when, and it is when, I think, this massive euro crisis comes to pass, we are going to see some financial shocks, particularly within European banking and to stock markets, that will actually reverberate around the whole of the globe. It is something to understand. It is a risk that you need to be aware of. It isn't going to happen next Thursday, but it is going to happen at some point before too long. If you're interested by what we've discussed in this interview, if you're interested in getting this book, click the link.